the NASDAQ fell a little bit further, down 1.01%, down 101 basis points on the day. Apple was up 1.1% for the session. NVIDIA down almost 5% on the day. What's up, apes? Welcome back to another edition of the 𝗙𝗟𝗡𝗚's Daily Podcast of the Day. Thank you all for joining us here once again at the world's most popular and influential podcast. We appreciate you being here with us on another beautiful Tuesday. It is currently October 15th, 2024. It is now 6:49 p.m. We got a hell of a lot to talk about here today. Earnings is back in full swing, so let's waste no more time and go ahead and get right into it. So, the S&P 500 was down about 76 basis points on this session here today. Most of the heavy lifting and bringing that lower was done by semiconductor stock for some not so great news that we'll talk about in a little bit. But we also saw weakness out of the energy sector in particular because there's heavy downward pressure on oil prices, probably for a good reason though, because this news emerged because Israel basically said that they won't strike Iran's nuclear sites, which is good for humanity, especially the people that are going to be in those regions, but not necessarily great for energy companies looking to increase their margins. So it's probably good for your bill at the gas station. Now, meanwhile, the NASDAQ fell a little bit further, down 1.01%, down 101 basis points on the day. Weekday for technology stocks, unless your name is Apple. Apple was up 1.1% for the session. NVIDIA down almost 5% on the day. We wrote about NVIDIA as well, so we'll break that down for you in just a quick second, but they are no longer nearly as close to each other in market cap. NVIDIA is still the second largest company in the world behind Apple and just ahead of Microsoft. Meanwhile, we saw a good day for the Russell 2000, up about 8 basis points for this session. So wasn't a whole lot of action, at least like universally kind of like mutual action among small cap stocks to be moving them in tandem. Good earnings for a lot of these small cap firms. We're seeing good earnings overall for the broader market. And once again, the market's general upward bias. And finally, the Dow, not that anybody cares, lost 75 basis points. Meanwhile, 𝗟𝗏𝗚𝗏 portfolio absolutely on fire for the session, lost only 56 basis points for the day. Shout out to Charles Schwab and a hell of a return that we'll talk about in a quick second. They really carried the team, but we're also, Apple, Zillow were big helpers on the day. I think Dollar General had a big up move as well. So overall, a good day for the apes at 𝗟𝗏𝗚𝗏. Moving into some of our banana bits for the day, fair warning, we do have a lot of these and most of them are just related to earnings. But before we get into some of those earnings, first and foremost, well, actually this one does relate to earnings, but fuck me, I guess. Okay, so Europe's second largest company, ASML, I'm pretty sure the largest is Novo Nordisk. I could be wrong on that, so somebody correct me if I am wrong. Probably some no-name fucking industrial giant that literally nobody has cared about since the Vietnam War. But nonetheless, Europe's second largest company, ASML, absolutely tumbled on the session here today. So it was a rough day because they decided to come out with their earnings on the same day that there was some bad news for the semiconductor industry. Basically, there's just more export controls coming out of the Biden administration, So more export controls painted a less rosy picture for global semiconductor demand and thus the industry going forward. But more specifically to ASML, the company also reported a bookings miss, meaning that they didn't live up to the demand expectation that the market had priced in. Meanwhile, Trump Media, this is DJT, that fake company that is absolutely hysterical to follow. The stock finished the day down 9.65%, even though, let me go ahead and check the tapes here. So Monday, October 12th, we closed at $29.95. And then Tuesday, October 15th, we opened up 7.5% higher at, I actually can't see what price this is, but we opened up 7.5% higher, and then we finished the day down 9.5% lower. So very volatile day for Trump Media. It was by far their most volatile day. There really was no news whatsoever. It's entirely off of the odds of Trump becoming president in 2025. So we'll see. I really don't understand this whatsoever, because it seems to me that the only benefit of Trump becoming president for Trump Media is that he can't sell his shares, because presumably he'll have to lock them away in some kind of a blind trust. But, Jesus Christ, who the hell is buying this? Somebody please write into me if you have a bullish thesis. The bearish thesis paints itself, but if you have a bullish thesis on Trump Media, please let me know. I'm dying to hear what it might be. Meanwhile, the United States made a surprise move here today. We're not going to talk too much about this because it's a bit of a sensitive subject, but the United States made a surprise move, and I guess the students over at Columbia managed to win because the U.S. is now threatening its homeboy Israel. The U.S. and Israel, they are thick as thieves, as my parents would, probably my grandparents would say, but they're tight. The U.S. and Israel are absolute boys. They're Jason Tatum and Jaylen Brown over there. But the U.S. is waving its finger at Israel and saying, we're not going to be able to send any more arms over there unless you fix the humanitarian crisis in Gaza. Basically, they're saying that they have to improve conditions for citizens of Gaza, and if they don't, the United States is going to stop selling weapons to Israel. Speaking of the Middle East, Abu Dhabi saw how well Vegas was doing with its Sphere and decided, you know what, I'm going to get me one of those. And they decided to build their own. So you don't have to go to literally the most degenerate, soulless, heartless city in the entire world just to see a decent show at the Sphere anymore. Go over to Abu Dhabi. All right, some earnings figures here. We're going to move right through these at lightning speed. United Airlines reported earnings. They were very similar to those of Delta. Shares fell about 0.5% on the day. Johnson & Johnson had a pretty solid quarter. Patients obviously did not, because the reason that J&J had a good quarter was because of a big uptick in cancer drug sales. Shares did move slightly higher, about 1% on the day. Transportation giant J.B. Hunt reported absolutely abysmal earnings. So obviously the share went up about 6% after hours, but basically what they're saying is that, yeah, the worst of the disgusting, disgruntled freight market in the United States is behind us, so things should be looking better going into Q4. Obviously, markets only care about what's going to happen and don't give a rat's ass about what happened in the last quarter. Finally, State Street reported a very solid quarter, higher fees, higher net interest income, higher AUM, higher AUC, all basically good across the board over at State Street and for a lot of these asset managers. Shares were up once again about 1% on the session. Okay, let's get into our big story here today. 6 minutes in already. Macro Monkey, we are talking about everybody's favorite thing to talk about, and that is, of course, bank earnings. So this is easily my favorite economic indicator. Banks are the financial lubricant of an economy. If you want to just make a pure play bet on an economy, like, for example, I've thought about, like India and Mexico are two economies that I'm probably the most bullish on. If I wanted to kind of maximize my potential upside, I'd probably buy like smaller cap, maybe regional banks in these areas and, industries. Regional banks within the regions that a lot of the manufacturing investment is coming into would probably be a good starting point, because banks are the most pure play way to just bet on a country's economy, because once again, they are the ones making the lending and kind of underpinning the entire financial and economic system that it allows an economy to grow. So again, if you want to get in on the gains for an economy, go ahead and buy their bank stocks. Now, it's Q3 earnings season. It's spooky season. It's the most wonderful time of year. These are all meeting each other here today. So sparks are going to fly. We're off to a hot start. I mean, most of these reports, most of the numbers that companies have been reporting have made analysts look like they're basing their projections on fucking astrology. But then again, we have to remember that it was the stars that got Christopher Columbus to the New World. And I'm absolutely hoping that this earnings season can do the same to my bank account, take it into a totally new world, because yeah, I don't know if we're going to be able to keep paying for the fucking Wi-Fi bill and keep this goddamn podcast going. Okay, let's go ahead and get into the first bank stock. So JP Morgan Chase & Co. reported earnings last Friday. This is the most valuable bank in the entire world. Not the largest by revenue. I believe that's the China Industrial Development Bank, or I think it's CIDC, or maybe it's CIBC. I forget exactly what it is, but it's one of those Chinese banks, Chinese state-owned banks, that is. JP Morgan is basically state-owned, though, too. Who are we kidding? Either way, JP Morgan, world's most valuable bank, reported earnings of $4.37 per share on sales of $42.65 billion. That beat estimates for $4.02 per share on $41.06 billion in sales, sent shares higher, just like a Jay-Z album, up 4.44%. So net income actually fell for JP Morgan, and for most of these banks, as we'll realize over the next couple of minutes, net income fell 2% annually, clocked in at about $12.9 billion. There was a larger than expected provision for credit losses, which ultimately hit earnings, but earnings still managed to come in above expectations as markets were kind of pricing for a slight decline here. So provision for credit losses came in at $3.11 billion. This was driven by $2.1 billion in charge-offs from consumers, so that was much higher than expected. Then another $1 billion to have on the books for the next quarter. Now, consumer banks, the consumer banking portion of JP Morgan, to really Chase loves higher rates, but the investment banking portion, not necessarily, or the Wall Street linked side of the bank doesn't necessarily appreciate that. So Altogether, JP Morgan is kind of the ultimate combination of both a Wall Street and a Main Street linked bank. That all told, the interest impact was a 3% rise in net interest income. Now, JP Morgan, being the largest bank in the world, has much less of an impetus than a bank like a SoFi or like an Ally Financial or like a regional bank to increase their deposits because they're so big. They're just ubiquitous at this point. Like, people probably don't even realize that they're fucking earning anything on their deposits. I would be surprised if more than half of Americans knew that. But overall, the Wall Street side of the bank was looking just fine last quarter as well. Equities trading revenue had a huge surge of 27% for the period. Fixed income trading was flat, but still managed to beat estimates as people were expecting a downgrade. Deposits and loans both grew 1%, and that's both deposits, loan balances, as well as the number of loans that are issued, all grew 1%. Mortgage lending was the only broad category of borrowing that posted an annual decline. Honestly, these results were so good. Investment banking fees were up 31%, which honestly makes me question if that 80-hour limit that the bank input last month is actually, or 2 months ago, is actually going into effect. So we'll see. I'm sure there's going to be some kind of an expose coming on about that, but hopefully it's a lot less tragic than what occurred at this bank. Bank of America here, the bank with easily the most freedom in the country, obviously, because it's Bank of America, reported earnings yesterday that also sent shares higher, up about 55 basis points for the day. Again, they just reported yesterday. Warren Buffett has been dumping his shares in Bank of America. I bet he's kicking himself, missing out on this huge 55 basis point gain. I mean, God, that doesn't come around too often. Yesterday's rise was driven again, obviously, by their earnings results. The firm reported 81 cents per share in earnings on $25.49 billion in sales. Estimates were looking for 77 cents per share on $25.3 billion. So again, beating across the board, facing very similar trends as JP Morgan. Now, Bank of America is much more linked to Main Street, to the consumer side of the economy than the Wall Street investment side of the economy compared to JP Morgan. Bank of America does have a big Wall Street business, but it's just the largest consumer bank in the country. So obviously they're going to be a little bit more linked to that. Largest by deposit size, not by number of accounts, by the way. Okay. So Bank of America, very similar trends. They actually saw a 12% decline in profits. Once again, linked to that consumer side is going to be a big reason for that. But they also had an uptick in loss provisions that surprised analysts. It was at $1.5 billion, which was much higher than was anticipated. Net interest income fell 2.9% year over year to $14.1 billion, still managed to beat estimates. Trading revenues were huge. Fixed income increased 8%, so I guess we know where all of JP Morgan's fixed income trading revenue went. Then equities trading revenue was 18%, and investment banking fees were up 18% as well. Deposits increased, loans and loan balances increased. The firm's wealth management unit was on fire. Basically, the wealth management units across all these banks were on fire thanks to all of them raising fees and AUMs going higher just along with market trends. Most of them did get deposit inflows as well, but just as equity prices increase, your AUM is going to increase, and thus the dollar amount that you're going to get from that fee is going to increase. But they also increased their percentage fees, and that's why in a lot of the CPI and especially the PCE reports, we've been seeing that investment management fees have had an outsized impact on the rise in overall inflation. Okay, moving on into Wells Fargo, the bad boy of banking, reported earnings that were even worse than the company's KYC and AML controls, but still they managed to beat estimates somehow. Shares were up 5.61%, the best return of the set for any bank, even though it kind of seemed like they had possibly the worst earnings of the set. So the company came out and reported $1.52 per share on $20.37 billion in revenue, beating estimates on the bottom line for $1.28 per share, but missing on the top line for $20.42 billion. I don't really know how that worked. Net interest income, fell 11% to $11.69 billion. Very nice, $11.69 billion. Street estimates were looking for $11.9 billion, so they actually missed on net interest income as well. Average loan and loan balances decreased. Deposits somehow managed to gain. Who the hell holds money at Wells Fargo? That's fucking crazy to me. But nonetheless, investment banking fees actually managed to decline to just $419 million. They decided to cut their provision for credit losses to $1.07 billion. So this bank just going in the complete opposite direction. Now, consumer banking and lending also saw revenue fall 5%. This was partially offset by a 5% increase in revenue from the smaller wealth and asset management division. Once again, it's just higher fees and higher AUM. But another big part of Wells Fargo that helped out quite a bit is its involvement in the venture capital space. Now, Wells Fargo is based out of San Francisco, so they're going to be more involved in this space, and that helped out quite a bit because private markets are once again on fire, largely just because of that return in M&A. That's helping out everybody else's investment banking fees except for Wells Fargo. So at least they're gaining somewhat from the return of M&A just on the venture side rather than the investment banking side, but I'm sure they would prefer if it was the exact opposite. Moving on into Goldman Sachs. So Goldman Sachs, CEO David Solomon, he's a real fucking wild boy out there. He's one of those older guys that thinks he's cool because instead of wearing like New Balances, he wears like Air Force Ones or something like that. He's kind of that type, like that how do you do fellow kids type of guy. David Solomon is the epitome of that. So he's literally a DJ. He's DJ D Soul. And so turns out this is going to be the cringiest joke I ever made. When he's not raising profits, he's out here raising the volume. And the only thing that dropped in Q3 was David Solomon's beats. I am so sorry for that, but I had to write it. I couldn't get it out of my brain. Revenue increased 7% for the quarter to $12.7 billion, pulling in $8.40 per share in earnings off of that. Both destroyed estimates. So they were looking for about $6.49 per share in earnings. So completely eviscerated earnings estimates and be it on the top line as well. Now, Goldman is the epitome of a Wall Street bank. They are entirely linked to Wall Street, barely any exposure to the consumer side, and they are damn glad of it. 18% surge in equities trading helped out quite a bit, rose to $3.5 billion in revenue. Fixed income side, revenue fell 12% once again, so again, a rough time on the fixed income market, but we're looking good in the stock pickers market. Investment banking fees spiked 20%. The firm's asset and wealth management division grew revenue by 16%. Once again, just higher fees and higher AUMs. Now, profits did surge 45% for Goldman compared to last year, but that more so speaks to the bad conditions of September of 2023 for Goldman. That was when they were kind of in the peak of winding down their Marcus unit. So Marcus was Goldman's attempt to go into consumers and then to basically get exposure to the consumer banking world. But then they realized that consumer banking is just a bunch of stupid, poor, gross losers like me and you. So they said, we got to get the hell out of here right now. They cut the Marcus business. I think they're still in the process of winding it down. But overall, that hurt earnings quite a lot last year. So that's why I see a huge gain for Goldman. Okay, last bank to talk about. Jesus Christ, we're 15 minutes into this. Holy shit. Last one to talk about here, we have Citigroup. Citigroup is kind of like the little sibling to all of these banks here. And, it did largely the same things as its older brothers. But anybody who is a younger sibling or who has younger siblings knows that that is a recipe for disaster. The little brother can't necessarily keep up with the larger brother. And that's exactly what Citigroup tried to do. Shares fell 5.11% despite the fact that the company delivered $1.51 per share in earnings on $20.32 billion in revenue, both beating expectations as well. Net interest income did fall 3% to $13.4 billion, shrinking margins as well because revenue rose just 1% for the year. There was an 18% surge in banking revenue driven by a 31% spike in investment banking fees. So at least Citigroup is dominating the Wall Street side. Now, wealth management revenue grew 9%, equities trading revenue was up 32%, and fixed income revenues fell 6% once again. This is the playbook of CEO Jane Fraser. So she took over in March of 2021, and since then, the entire bank has been undergoing a huge business transformation. So it's one of those business transformations that's so fundamental, we don't even really know what's going on. Like, the biggest thing that Jane Fraser shouted out was data process and management quality. So this was one of the big focuses that they talked about on the earnings report, how they're going to be improving data management processes and quality. What that means, I have absolutely no idea, but I imagine it means kind of speeding things up and maybe coming into the 21st century. Most of these banks still have to come into the 20th century before they can come into the 21st, but still, seems like Citi is moving in the right direction. They're kind of, what's the saying? They're taking the hard part right now, doing the hard part first, and then hopefully they can, kind of come off of that. But overall, we're going to get Morgan Stanley's numbers out tomorrow. So that'll kind of round out the big six banks in the United States. But so far, these are the big takeaways that we have. I think I have 8 of them here. So get your fucking notebooks out and get ready to write this down. First and foremost, first takeaway, the declining interest rates have already benefited primarily Wall Street linked banks. So this is through things like we're seeing declines in treasuries, declines in mortgage yields, not necessarily, underlying interest rates, but it's already kind of helping out on the Wall Street side. Rising rates were a boon to Main Street linked banks, but might not be any longer. Net interest income is falling primarily due to declining lending rates, while also slightly increasing deposit rates, especially at firms like Bank of America and Wells Fargo. So what do I mean by this? Basically, we're seeing net interest income get squeezed nearly across the board because these banks, while they are these banks, the consumers know what's going on with rates to a certain degree. They don't necessarily know what they're at, but they know kind of what direction they are moving. So consumers that are taking out loans now are expecting lower rates than they would have gotten 6 months ago, a year ago especially. So these banks are likely having to cut the aggregate rates that they're issuing on things like personal loans and, everything across the board, especially to other companies as well, because these companies definitely know what's going on with interest rates and will be able to negotiate lower rates. So at the same time that they're lowering rates on lending that they're giving out, they're at the same time having to continue to increase the APY on deposits if they want to retain deposits, especially, like I said, at those firms like Bank of America and Wells Fargo. So that's largely why you're seeing this squeeze of net interest margin, especially these consumer banks. But again, going back to the investment banking side, this is our next takeaway. M&A is confirmed back as we're seeing investment banking revenue and specifically investment banking fees, as well as Wells Fargo's venture capital unit working improving quite a lot for the last quarter or so. Now, meanwhile, the stock pickers market is also helping out quite a bit for professional equity traders who actually know what the fuck they're doing. Now, it might not be great for us idiot retail traders that are just fucking picking letters out of a Scrabble bag and throwing the house on that, but these people who actually know what they're doing are doing great in the stock pickers market. Banks are very nervous about customers repaying loans, hence the increase in credit loss provisions, but at the same time, it seems that consumers are still hesitant to take out loans. And finally, asset and wealth management continues to be the long-term secular growth driver of the industry. So overall, painting a pretty good picture of the U.S. economy in its current state. There's reason for concern going forward because of this rise in provisions for credit losses. But overall, it looks like the most wonderful time of the year isn't going to get infected by spooky season and should live up to its name and be truly wonderful. Jesus, that took a while. We're at 20 minutes. Let's go ahead and move into these big stock movers of the day. First and foremost, we have Walgreens Boots Alliance. This stock hasn't moved higher since 2015. I swear to God. Shares were up 15.71% for the day, and it's time to cue the High School Musical music because this is Walgreens' now or never moment. So the company shares are down 90% since July 2015. Even after yesterday's return, they are down 90% since July 31st of 2015 because the company has just completely fallen apart. Weak foot traffic and also just a shitty-ass pharmaceutical distribution business has hurt this quite a bit. I'm thinking of doing a deep dive into the absolute collapse of Walgreens, but, we'll see if that's something that you guys actually want to hear about. Earnings expectations were set lower than a fucking preschool's basketball hoop, and so the company was able to beat estimates, but still, the most exciting news about Walgreens' report is that it's going to be closing a bunch of Walgreens stores. So the fact that shares are moving higher while you're actively offing yourself as a business is probably not a great sign for Walgreens. They're going to be closing 1,200 locations. They have about 9,700 locations, so more than 10% of their locations are going to be closing by 2027. CEO Tim Wentworth said that, about 500 or so should be closed in 2025. That should be, quote, immediately accretive to earnings per share. So shareholders are pretty fired up about that. I can't imagine still holding Walgreens at this point, but goddamn, what a miraculous disaster that's going on over at that quote-unquote business. Okay, Charles Schwab up 6.10% for the day. This is one of our holdings in WSO Alpha and a stock that no big deal, but before this quarterly report, actually, I think it was 2 or 3 months ago at this point. I really don't remember what it was, but we put out a report on Charles Schwab, gave it 5 stars and said you should absolutely buy this thing, and now the stock is up 6.10%. So no big deal, and you're welcome to anybody who bought that stuff. You can go ahead and send me my commission whenever you'd like to. But the stock was up, again, just a little bit over 6% because of a very solid earnings report. So revenue grew 5% annually to $4.85 billion, well above the $4.78 billion that was expected. Net income soared 25% to $1.4 billion or 71 cents per share, beating estimates for what would have been a very nice 69 cents per share anyway. So deposits declined, but only by 2%. More concerning was a 1% decline in net interest income, but analysts decided to pay more attention to the beats of earnings and revenue expectations, a positive outlook for Q4, and a 9% jump in client daily trades. You're welcome for that, by the way, because Charles Schwab is also where we host the WSO Alpha portfolio. So, again, a great quarter from our custodian as well as one of our holdings. Okay. Moving on down into our stinky rot moves of the day, we have United Health Group, which is down 8.11% on the day. This is the largest health insurer in the world, and the absolutely only thing that made investors feel united with this stock today wasn't their desire to dump all of their holdings. So this company really needs a prescription for Prozac because one of the biggest detractors for the day was a weak outlook for Q4. So the company reported $7.15 per share on $100.8 billion in sales for the quarter. Yes, $100 billion in a quarter. That's the kind of numbers this firm is putting up. That beat estimates for $7.02 and $99.5 billion. But again, weak outlook. So the company said that they continue to expect a maximum of $30 per share in fiscal 2025. Markets were pricing in a maximum of $31.18. So because they had that priced in, now that it's coming lower, the share gets hammered for that and not hammered in the right way. Okay, moving on down into our final mover of the day, we have NVIDIA down 4.52%. Didn't even realize this was possible, but it's very much like when your mom would be like, you know, back in elementary school when they found out that like your friend's parents like smoke cigarettes or something, and they're like, you're not allowed to go over that house anymore. That is exactly what happened to NVIDIA today. So mommy and daddy in the the Biden administration, excuse me, came out and said that they are considering putting export caps on companies like NVIDIA, like AMD, on the number of artificial intelligence, of AI chips that they're able to send over into the region. So they see it as a national security concern. For NVIDIA, it's a revenue concern, obviously. Saudi Arabia was the biggest one in question. So PIF, the Public Investment Fund of Saudi Arabia, has already set aside about $40 billion to invest in artificial intelligence. They're working with U.S. firms like 𝗟𝗓𝗡𝗏 Horowitz to do so, investing in a lot of U.S. startups. But the goal is to foster development of 50, I think they said like globally systemic or what, I forget the exact terminology, but they basically want to have like 50 actually important tech companies in Saudi Arabia by 2030. And I think they're relying on artificial intelligence chips to do so. And the US said, no, not so fast. We are the only country that's allowed to have tech companies, so we're not going to be sending this shit to you anymore. All right, 25 minutes into this, let's finish up with the thought banana of the day before I fucking run out of breath, pass out, have a heart attack, and poop myself all on camera. Okay. Thought banana, we are talking about the big screen, but small dollars. So we're all very familiar with the most famous movie star of our generation. I think her work is underrated, if anything. She probably doesn't get enough attention, but biggest movie star of our generation, Miss Kim Kardashian, is going to have to come in and save the day here because the entire film industry is struggling once again. So 2 years, there were 2 years following the pandemic that it looked like the box office might be making a return. 2021 and 2022 saw some big growth. Now, obviously, that was largely because of the absolute disaster that happened in 2020. So I went ahead and ran the numbers a little bit here today. It was a painstaking process of data entry because I couldn't fucking download the shit from IMDb's website. But nonetheless, we went ahead and ran the numbers on the top 10 grossing films from each year in the last decade or so. So we're going back to 2014. We're finding out what were the top 10 highest grossing box office films of the year, and we're just adding up all those numbers to get the total and kind of approximate what the box office was like for that year. So 2014, $7.90 billion. That was actually an 11% decline from 2013. Meanwhile, in 2024, we are now at $7.418 billion. So we're actually 6.2% lower than where we were a decade ago. Now, a lot of that is largely due to the trends that were created from a 75% decline from 2019 into 2020. The number one movie, let me know if any one of you saw this, but the top grossing global box office movie of 2020 was something called Demon Slayer Kimetsu no Yaiba, the movie Mugen Train. I guess I have never heard of this before. I don't know what it was. The second one was The 800, which I also haven't heard of. The third was Bad Boys for Life. That must be based on my life or something like that, but I still haven't heard about it. The only one that I do know is Tenet, which I actually did have the misfortune of seeing back in 2020. So overall, 2020 was a big year for the box office and how it absolutely destroyed things. Now, 2021, there was some pretty solid growth. So we were like, maybe people are going to be going back to the box office. Now, the total for the top 10 was up 125%, led by Spider-Man No Way Home, The Battle at Lake Changjin, Hi Mom, No Time to Die, Fast and Furious 9. So, you know, some decent movies in who am I kidding? Trash movies still, but it still sent it up 125% in 2021. 22, we saw growth of 33%, and then we're right back to declines in 23 and 24 so far. So 2023, we saw a total decline of 18.76%, and in 2024 thus far, we've seen a decline of 10.62%. So all in all, really bad trend for the box office post-pandemic. Now, a lot of people were thinking that this might be similar to the travel boom, that, you know, being pent up and tortured by having to hang out with our families all day long for an entire, couple months. Oh my God, it was awful back in 2020 and 2021. Kind of made us think that, you know, maybe people will be looking for any excuse to get the fuck away from the other people that live in their house. So people were kind of pricing in for an experiences boom in addition to the rumored travel boom. So we know that the travel boom came to fruition. The experiences boom did as well. Just look at Airbnb's experiences revenue. But the box office was not part of that experience return that many thought it would be. So once again, absolute trash performance, which is pretty surprising because 2024, we've come out with some absolute bangers, dude. Inside Out 2, come on. Deadpool and Wolverine, I didn't see it, but was actually probably decent. Despicable Me 4, who doesn't love those annoying-ass fucking minions that make me want to shoot myself in the face every time I see them? So, overall, if if cinema is truly reflective of a culture, we're even more fucked than I had anticipated. I'm not even a cinephile or anything, but Jesus Christ, it's just absolutely abysmal. I saw a stat today, actually, Sherwood News went big on this, that some movie called Terrifier 3, which is about some coked out clown and only gets views because of how much gore there is in the movie, so I'm definitely going to be watching it later tonight, absolutely blew away the Joker. And this was from like a $250,000 budget for Terrifier 3 to the new Joker had probably tens of millions of dollars in budget. People are walking out of both movies, but they're walking out of Terrifier to fucking throw up. They're walking out of Joker to hate on it on Twitter, it seems like. So that's what kind of got me thinking about this stuff here today. So for anybody who thought that there was actually going to be a return to people attending movies at the movie theater, I can only respond with a quote from a certain former president on the debate stage. Wrong. Absolutely wrong. And just so we can kind of hammer this home, let's go ahead and take a look at some more data. We're a half hour into this, but fuck it. If you're here this long, then you probably want to hear about this stuff. So let's go ahead and talk about it. The 5 biggest box office movies since 2020, since the pandemic, have been first, Avatar: The Way of Water in 2022, raking in $2.32 billion at the global box office. Then was Spider-Man: No Way Home in 2021 at $1.91 billion, Inside Out 2 2024 at $1.69 billion, Top Gun: Maverick at $1.5 billion, phenomenal movie back in 2022, Barbie $1.45 billion in 2023. I still haven't seen that. And then we have the Super Mario Brothers movie up to $1.36 billion in 2023. So going back to 2014, we can see that the top performing titles of any year, really every movie that's in the top 10 for any one of these years, at least 90% of them, banks its success on one of 3 things or a combination, some kind of combination of these things. And it's either movies for children, or movies that are just banking purely off of nostalgia and superheroes. That's really the big 3. It's either the Avengers, a remake of a classic title like Super Mario Brothers or Dune, or just anything that's kind of trading on nostalgia or an idea that somebody already had decades ago, or it's a movie for children, which, have you ever... we were actually just setting up the bookcase for my soon-to-be-born son, who's going to be born in the beginning of December. Have you ever read a children's book? Anybody could shit that shit out. So I assume it's the same for a movie. Like, it's, oh my god, it's abysmal. You could have a fucking, like, cartoon penguin clapping on screen and these kids will love it. Remember what happened to Baby Shark? That was like the biggest media event of the last decade or so, and it was once again entirely for children. So the other big reason for this fall off of the box office obviously is going to be Netflix, and specifically the streaming market in general. Netflix's revenue for the same period that we're looking at is up 613%. So while box office revenue is down 6.2% since 2014, Netflix's quarterly revenue, Q2 2024 compared to Q2 2014, is up 613%. So you extrapolate this to the other streaming services, paints a pretty clear picture at that point. But honestly, with that in mind, I'm kind of impressed with how well the box office has been able to keep up. Really, the big problem is titles. It seems that consumers will go to the movies to see something if it's worth going to see. But if you keep putting out absolute fucking trash like The Croods, Twisters, Godzilla and Kong, just this disgusting, mindless, meaningless nonsense of movies, then obviously nobody's going to go ahead and see those. So if you're in Hollywood, make better movies, because it fucking pisses me off, dude, I mean, we're all going to have TikTok brain anyway, but at least we can fight it a little bit if we go and see, a 2-hour, 3-hour movie or so. So that's my rant for the day, so I had to fucking write about it. That about does it for us. Jesus Christ, 32 minutes. Patrick's not going to be very happy with this performance today, so apologies in advance. But if you're still here, I love you. Thank you for sticking around. Write me an email and tell me, what your favorite movie of the last decade. Just, shoot me a message or something, and maybe I'll shout it out on here. That about does it for us today, though. Obviously, thank you guys for joining us here once again. It is currently 7:21 p.m., so it's dinner time for me, baby. Otherwise, I hope you guys are having a great week so far. I hope you're having a fun Tuesday, and most importantly, hope you're having a profitable earnings season so far. If not, happy investing, happy trading. Best of luck, and we'll see you tomorrow. Bye now.